Our day-to-day investment decisions have to be governed by a long-term plan for us to reap future rewards. This means making decisions by filtering the day-to-day headlines through our model versus making emotional decisions. Over the past several months, the market has shown remarkable resilience in the face of tariffs, geopolitical concerns, and this week in the aftermath of a 20% decline in Facebook. The market may be sending us a message about long-term prospects for our investments. We open with a summary of this week's economic data and interpretation. The economic calendar had important readouts this week on home sales, business spending, the labor market, GDP, and consumer sentiment. While housing continues to be a soft spot in the data, overall, the economic data remains quite strong. Now we'll look at our week in review, where we take a look at the headlines and how they move the market. On Monday, the market rose on strengthened financials. On Tuesday, stocks continued to rise on strong earnings. On Wednesday, the market continued with strong gains on an announcement by Trump and Jean-Claude Juncker, President of the EU, to work together towards zero tariffs. On Thursday, the market showed incredible resilience in the face of a 20% drop in Facebook stock. On Friday, Q2 GDP came in at 4.1%, which is one of the strongest numbers since 2014. A smoothed average of the GDP numbers shows that the economic growth trajectory is stable and the economy is very strong. Technology stocks weighing on the market were a likelier story for the market's decline. For the week, the S&P was up 0.62%, and the month and year-to-date statistics are provided at lower right. Before we move on, I'll show you two other areas of note on this chart. There's a gap in price between Monday and Tuesday. Sometimes gaps can serve as support, and as we see on Friday, price tested this area and at least temporarily found support. There's also a heck of a coincidence at the top of this chart. This red line is where price found resistance, which coincidentally is exactly the same value of 284 and a penny of the high the day after the market peaked on January 26th. Again, to the penny. Since we just covered economic data and how the technology sector weighed on the market toward the close of the week, let's look at how we follow and seek to profit from trends in sectors. This chart is based on Robert Wygand's model of the business and financial cycles. The cycles themselves are shown in the middle of the chart, with the financial cycle in blue and the business cycle shown in orange. The industries are shown across the top, and the phases of the cycles are shown across the bottom of the chart. We use the performance of the sectors to determine where we are in the business and financial cycle. This allows us to determine what sectors ought to start trending as we move through the cycle. So where are we? Let's look at the year-to-date performance of the sectors from strongest to weakest. Each of the sectors will list the ETF ticker symbol first. We have cyclicals at 14.7%, technology, services, energy, basic industries, utilities. Financials are still struggling as business and consumer borrowing is constrained by existing debt. Industrials, and let's pause here for a minute as well. This sector was doing very well throughout 2017 and coming into the year and has been traumatized by tariffs. The good news is that this sector is beginning to see some relief. We'll continue to look at how we can spot early turns in sector rotation in a few minutes. Our last and weakest sector is consumer staples. So looking at the center of the cluster of strongest sector performance, this is where we are in the cycle. Contrast this with what we often hear about the cycle being long in the tooth, an aging bull, etc. In the late 1800s, before we had robust data, we used a decline of 20% in the market to define a bear market and determine when a new bull market began. Today, we have an incredible amount of data available to us and computing power, which enables us to use technical indicators. These indicators were reset during the 2015-2016 sell-off that resulted in a 15.8% drop in the market. These early business cycle readings reflect regulatory rollback and tax reform, but they also reflect, as industrials do, headwinds from tariffs. They also reflect what may be years that we have left in the bull market. The question for us is, what sectors do we want to allocate to based on where we are in the cycle? We can't answer that question just based on this slide because of the long time horizon. But based on what we have here, some allocation to leaders seems to make sense, and an allocation to the next set of leaders is where we would expect to get our largest gains. A quick reminder that all of the information in this presentation is our opinion, and these are not investment recommendations. Trend strength is another part of the answer to the question of how we allocate. If the trend is very strong, then we have to make sure it's not a peak in a trend that is about to end. Remember, we want to get into confirmed trends in their early stages. This measurement of trend strength is the output of one of our proprietary models. Most of the sectors at the top of the list have been in very strong uptrends for quite some time and are now showing signs of either rotation or needing to consolidate strength. Again, if we've done our job, we're already in the strongest sectors and we're keeping an eye out for the end of the trend. The other part of our job is watching the next crop of leaders, confirming trends, and then taking appropriate positions. Think about the sectors at the top of the last list, and think about a generalized trend. Those showing the most strength are on the way up to the peak, and at some point we'll get there. We don't want to buy at or near the top. With the 20% decline in Facebook, there's a lot of discussion about investment rotation out of the technology sector right now. But I would suspect it will be a rotation within the sector into subsectors within the space. What we do want to do as trend followers is buy as early as possible in a confirmed trend and sell after a top is confirmed. Buying rising sectors in confirmed trends allows us to capture a greater portion of the trend profit. So the question now becomes, what is another tool that we can use to spot changes in trend strength and rotation so that we can identify sectors in the early stages of trending and then confirm the trend using technical analysis? One of the tools that we use to visualize the rotation of sectors is called a relative rotation graph. This compares sectors to the S&P using momentum and relative strength. Think of the S&P as being in the center of the graph with crosshairs. Sectors with the highest momentum and relative strength compared to the S&P will be in the leading quadrant at the upper right. These leaders tend to rotate to weakening, then to lagging, to improving, and back to leading. While this occurs with a high degree of regularity, as with all things in the market, they don't always move in an orderly fashion. Looking at this graph, you can see that energy was a leader that has moved strongly to weakening. Staples, on the other hand, strongly moved from lagging to improving. Does this mean that we should buy staples and sell energy? Again, this is just one piece of data, and we need more information. The tails on each of these represent 5 weeks of data, which is not enough on our long-term time frame. But these charts are useful on shorter-term time frames to spot emerging trends and then validate them, using technical analysis on longer-term charts. So let's look at a monthly chart of staples. This is not the type of chart that we use, but it will help us visualize the trend for the purpose of this presentation. Looking at consumer staples, we see a bullish trend on the left, where the moving averages have a positive slope, there's good spacing between them, and for the most part, price, as shown by the candlesticks, is above the moving averages. At the right side of the chart, we see the trend looks like it's rolling over, with price increasingly dropping below the moving averages, and the faster moving averages crossing under the slower moving averages, not the sector we'd want to buy. How about energy? We see a bullish trend at left, which rolls over and then shows signs of recovery. So let's go back to our business and financial cycle slide. If the only sectors we could choose from were energy or staples, which is the likeliest to trend next in the phases of the financial and business cycle? Clearly, it's energy. In fact, that trend is already underway. These are not the only sectors we can invest in, which is why we look at far more factors to make our selections than what we can show in the time that we have available for our presentation. Now let's shift gears and look at the charts. This is the chart from last week's video where we looked at the cup and handle pattern. We said that the red line overhead represented potential resistance for price, just like the horizontal blue line or the rim of the cup represented resistance to the last breakout. Price ran into resistance and corrected. We also said that there would be a fear of missing out that would eventually drive us over the red line and onto new highs. The long-term bullish trend is still intact, and we still believe that to be the case until the charts and evidence tell us otherwise. Here's an updated chart with this week's price action. What happened? We ran into resistance at the red line. Does this mean that we failed at resistance and the market's going to crash? It could, but given the empirical evidence we have on the charts, that's unlikely. It's more likely that this is a reaction to weakness in tech that needs a pullback or a consolidation before continuing to trend. We can't manage a 5 or 10-year investment horizon on a daily chart. We have to stay focused on the charts and the long-term evidence. So what is the long-term evidence for the tech sector and the S&P? Let's look at a monthly chart of the QQQ or the NASDAQ going back to 1999. We have the dot-com bust and the crash in 2008, and the NASDAQ moved sideways for roughly 17 years before surpassing the 2000 dot-com peak. A quick look at the moving averages shows a bullish trend. Looking at the S&P, the market moved in a sideways range for roughly 16 years before clearing the 2008 highs in 2013. We got a technical reset for the restart of the bullish trend after the 2015-2016 sell-off, and once again the underlying moving averages show a strong long-term bullish trend. Could we suffer a 2 to 5% pullback before we attempt to surpass the January highs again? Absolutely. But as you can plainly see, over the long term, we're still in a bull market. On the next slide is a passage from a book. It's longer than the usual quotes that I include in these presentations, but I'm quite sure you'll find it worth your time to pause the video and read through it. That particular turn of phrase, "It's a bull market," is from this passage. Read it and contemplate what the evidence on the charts is telling you for your long-term investment plan. Should you sell based on the market being entitled to a short-term correction, or should you keep your eye on the long-term trend? We'll keep our eye on the model and the long-term charts as we go into next week. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.